Morning, Shane. Thanks very much for joining us again at Blue Notes on the morning of the trading update. Actually, it looks a very solid result, particularly strong growth in retail and commercial in Australia, good deposit growth, good markets performance. Were you happy with the composition, and I suppose is it sustainable?
Yeah, we're pretty pleased with the result. I mean, it's early days. It's the first quarter of the year, and we're going through quite a transformation at ANZ. But yes, we're really pleased with how the year has started. We're getting growth in the right areas, the areas that we committed to, the areas we want to grow. And we're seeing the performance, even in global markets, coming through exactly where you would expect it to be. There's been a little bit more volatility, a little bit more customer activity. And so that's, I think, a really pleasing way to start the year.
And when we look at revenue and growth in particular, for a long time we've been warned about a low growth environment, expect a low growth environment. There's an element of trading income in here too. I mean, given that background and what you've said in the past, is it that we're growing too fast even?
No, I don't know that we're growing too fast. I think the reality is that the economy has slowed down a little bit. Hey, Australia's still a great place to be, New Zealand's a great place to be, Asia's a great place to be, but the growth rates have just tempered down a little bit, and we've seen that. And that affects our business. We reflect the state of the economy by and large, and you see across the banking sector, revenue growth, asset growth, lending growth, it's all just been a little bit more subdued than we've been used to. And that puts the onus on us to be just even more focused on productivity and efficiency to ensure that we can continue to deliver great things for customers, but also deliver a decent result for shareholders.
And indeed, one of the real strengths here, looking at the numbers, is that cost performance. You've made significant change in the 14 months or so that you've been here now. Can you talk us through those cost reductions, and should we expect more? And you mentioned that the point of this is to pass it on somehow, the cost reduction.
Yeah, we've had a view that the world's growth, the world that we live in, is just slowing a little bit. And therefore, as I said, in that view, we've got to be even more efficient if we want to win and be winning with our customers. So we started early, I think, and we delivered a great cost outcome last year, where we kept costs pretty flat. And this year, in this quarter anyway, we actually cut costs down, and that's a pretty big step for large organisations like this. And there clearly has to be more to come. Why? Because that's the only way we're going to have the resources to deliver really competitive product for our customers and be able to invest in new things, new technology, the whole kind of digital platform that we want to build to service our customers better.
And that's the tension, isn't it? You want to take costs out of the sort of ongoing business, but invest in digital. Have you got the capacity to invest in that full slate of digital and technology that you want to?
I think we've got enough, and at some level you can never have enough money to invest in digital, but the reality is it's about getting the right cost mix. So we've really focused, in terms of where the cost out has been, we've really focused around the kind of non-customer facing costs. You know, just the bureaucracy, how we run things at the bank, to simplify the place, to be doing less things in less places and do those things really, really well. You actually get a cost benefit out of that, and that allows us to reinvest some of that into more customer focused costs, things like Apple Pay, things like the whole digital experience that we want to continue to improve.
The other area of concern coming into this reporting season, and not so much for ANZ but for the environment in general, was that credit quality story. Again, a good result here, but is that something that we should expect over the 12 months ahead?
So we've always got to be cautious when we look at credit quality because, you know, one quarter doesn't make a year. And we know that historically, for our business anyway, the first quarter is usually a low point in terms of credit costs. So it's usually the most benign for all sorts of seasonal reasons. Having said that, a year ago, or when we had our full year result, we kind of said, look, when looking forward, we would expect the 2017 to be more or less the same as 2016 in terms of credit costs. Sitting where we are today, and with that proviso, the first quarter isn't always the best indicator, you'd have to say you're looking a little bit more optimistic today. So we would expect them to be marginally better than that. But as I said, it's early days.
Another one that's perennial in recent years for banks is the capital position. The regulatory environment is still not certain. We're getting a bit more certainty, but good capital generation here and some asset sales still projected for the year ahead. Can you talk us through where you look?
So our number one priority is to have really strong organic capital generation, i.e. that we just run this business really well, servicing customers that will naturally generate cash that will boost our capital position. And that was really a standout, I believe, in the quarter. And what we've seen there is almost doubling of that capital generation in this quarter compared to what it's been over the last number of years. So that alone has put us in a great position. And then on top of that, we've been disposing of non-core assets, businesses and assets that we don't believe are important for our future customer franchise, and they even add more into that capital position. Not in this quarter, but they certainly will come in the future. So we've really transformed ANZ from a capital position pretty early on, I think, and there's more to come on that, and that says we're in a very, very strong capital position. In fact, the strongest we've been in for a long time, and I think relative to our peers in an incredibly strong position.
Much of that reshaping you talk about has been in the institutional bank. How has that played out in terms of customer satisfaction and the performance of the institutional bank?
Yeah, we made it clear that the right thing to do for institutional was to be a more focused bank, to be focused on those customers that are really on strategy for us. And that's essentially customers who are in the business of moving goods and money around the region. That's what we do really, really well. And so yes, we've been shrinking our balance sheet, been shrinking our number of customers. There's always a risk with that. You know, are you shrinking the right customers and assets? And I think the team here have done a really fantastic job. It's early days, but they're getting the right assets are going to the right customers. What we've seen is margin improvement. And actually, we'll be releasing some data soon that'll show that the customer satisfaction, particularly in our Asia franchise, is actually holding up and improving as a result. And that may seem counterintuitive, but it's not. It's because we're able to focus our smaller resources against those customers that we really care about, that we can do a great job for. And that's, I think, really commendable for the institutional team.
Well, thanks very much for speaking with Blue Notes again. Good luck with the year ahead.
Thank you.